one on an accrual basis? Well, what we're going to do is, for the purposes of this course, we're going to assume that you are keeping two sets of books. But in practice, we don't do that. What we do actually is we prepare it on modified accrual basis or accrual basis and have worksheet entries which convert them into the other basis of accounting. So in practice, it's very, very different, but for our purposes, we're going to be using those two sets. Okay. Is everybody still here? Yes. I'll assume you are. Okay. You probably wonder why I get so excited about this stuff, right? Okay. First of all, you need to understand the definition of a fund. So what is a fund? A self-balancing set of accounts with its own financial resources, liabilities. It's like your own little company, like your own little, for whatever the purpose is. Right? Its own set of books, statements, chart of accounts. So if you want to just keep it simple, think of it like a little subsidiary, all on its own. Okay? That's what a fund is. Except it's based on flow of financial resources. These are the different types of funds, governmental funds, and we'll be spending time on this. We'll be going through each one of these funds. Let's start off with the governmental funds first. General fund, the granddaddy of all the funds. This is where everything goes through. If you don't have any fund, you'll have one general fund because government need that to operate. Okay? Sometimes it's called the current fund, general fund, whatever you might want to call it, but this is where you record all the operating transactions of the government. Cost for police, fire, recreation, whatever it might be. Now we come up with special revenue funds. These are restricted or committed for a specified operating purpose, such as maintenance of roads, bridges, and operation of a library. Okay, so when you go out, fill your car with gas, part of the cost per gallon is what? A fuel tax, right? And what's that tax used for? To maintain highways and bridges and all of that, right? So could the state of New Jersey set up a special revenue fund? Yes. Where would the revenue come from? The fuel tax, and what would the cost be? To repair what? Roads and bridges. Why did they do that? To keep it separate from everything else, so that they could properly account for it. Hurricane Sandy, federal government sends money to the state to do work. Federal government says, give you the money, but don't mix it up with other stuff. We want it to be kept separate, and we want you to account for it separately. Special revenue fund. Put it in there. You know where the revenue came from. You spend it for that purpose. Government auditors come, look at that fund, and say, you know, everything looks good. That's special revenue fund. Dedicated for a specific task. Could you have more than one special revenue fund? Sure. Though it's not a good idea to go crazy. Okay? You know, another example would be like the casino revenue from Atlantic City. You know, they get a cut of that. So there are lots of examples there. Another piece is debt service fund. What is this? Okay, now let me just explain this to you. When governments borrow money, the people who lend them money want to make sure they get paid. And they lend them money because they know if governments get into trouble, what can they always do? Raise taxes, right? That's why they are not afraid to lend them money, right? Though we have found out that that doesn't always work with bankruptcies. But what bondholders do at the same time is they want to make sure they get paid their principal and interest right on time. And what they put into the bond covenant or the bond agreement or the bond indenture is a provision which says that you will deposit the principal and interest for repayment into a debt service fund. So when I come knocking on your door on December 31st for my payment, you're not going to say, oops, I spent it. So what they do is the general fund literally takes the principal interest that's budgeted and transfers it into a debt service fund. And the debt service fund, when principal and interest come due, pays the bondholders. So you could literally have a debt service fund for each large bond issue, though people don't do that. But that's what happens in government, is that just to make sure that bondholders get paid, it's set aside separately. So that's the purpose of debt service funds. Once the debt is paid, do you still need it? No, there's no need. You've paid it, you can close that fund. So how many did we look at so far? 3, right? General fund, special revenue fund, debt service fund. We got a couple more to go. Yep. Capital projects fund. Okay. So a government decides to build a new building. City Hall. It's going to cost a lot of money. So what do? They go out borrow money. And the money comes in and they say, you know what, because of this large project and we want to make sure things are done right, let's create like a construction fund, like a place where we can deposit these monies and track how it's being used. That's your capital projects fund. So it borrows, let's say, $1 million, puts it into what? The capital projects fund. And what does the capital projects fund do? It pays off the contractors. Once the building is finished, the capital projects fund closes. Some people think that the capital projects fund actually carries the asset. It doesn't. Once the asset is done, it's completed. So capital projects fund are used for construction of major projects by government. Okay? That's why they're called, by the way, you see their technical term, general assets, general capital assets. That's the right word. Instead of just saying capital assets, we add the word general capital assets to denote that that involves government, the governmental funds. It's because if you just said capital assets, I could ask you, are those capital assets of business activities or are those capital assets of governmental? By saying the word general, I'm telling you that's a governmental capital assets. And my favorite, permanent fund. If you want to see this in action, move to Alaska. And I really mean that. If you lived in Alaska and you made your home in Alaska, every year you get a dividend check from the government, oil money. Alaska has a permanent fund for its oil royalties that it receives. And what it does is, so every year they get billions of dollars that's deposited into this fund. They're smart, they don't spend it. They put it in this fund. I'm sure they spend some of it, but they put it into this fund, and whatever earnings come out of those funds are distributed back to all the citizens. And maybe someone can do a little research later on, tell me what the check was each year, last year, for people who were resided in Alaska. You just get a check from government, $2,000, $3,000, whatever that number is, because that is a permanent fund, because what a permanent fund is a fund where the principal is kept intact, but the earnings are dispersed. It's like an endowment, okay? And not many states have that. That's why it's at the very end. It's for a public purpose. What's the public purpose? To give money back to all the citizens. What could be a private purpose? Well, a private purpose would be if people gave money to a town for educating children of police officers who were killed in action. It's to a specific group, right? Those are private purpose trust funds, and they are actually accounted in fiduciary fund. I don't know if you noticed that. But this is really as simple as what I just told you, the permanent fund. And those are the governmental funds. Any questions? Again, same old thing goes on and on as to understand the difference between expenditures and expenses, please. And you know what? They're not the same thing. And I'll later on give you examples of how expenses don't always equal expenditures and expenditures don't always equal expenses. Because one is modified and other one is full accrual basis. And we'll take a look at the example. My favorite example actually is interest payment. So I'm a very clever CFO who works for government, and I need to raise some money. So I say, okay, what I'm going to do is I'm going to borrow money on April 1. So my bond is outstanding for how many months? 9 months, right? From April 1 through December 31st. So interest expense would be what? For 9 months, right? But under modified accrual basis, how many times do you usually pay interest on a bond? Twice, right? Every 6 months, right? Probably learned that in your finance course. Every 6 months you pay interest. So when's the first interest payment? If you borrowed money on April 1st, the first interest payment is October 1st, right? 6 months after you borrowed money. When's the next interest payment? April 1, right? But April 1 is when? The following year. Guess what? You don't have to do accrual in governmental funds because it's not flow of financial resources. Nothing's, even though the liability is there, but what you can do is skip 3 months of interest accrual on your books because you're using the flow of financial resources. That's the difference between modified and full accrual. Again, we'll talk more about this later on, but I wanted to explain to you how that works here. We looked at the statements already, so I won't go into this, but let's just have a little fun with some of these transactions. Look at this. The city issues a 3%, 5% note, 3-year 5% note in the amount of $400,000 to purchase a building. When you borrow money, what do you do in a transaction? You debit, and what do you credit? A liability, right? Notes payable, some kind of a liability. What do? Other financing sources, proceeds of 3 years. All I can tell you is you don't know anything about this account. This is not a liability account. This is a type of revenue account. Flow of financial resource. Money coming in. Doesn't matter how it comes in as other financing source. Take a look at another example. Same thing now under the accrual basis. This is what we're used to. Governmental activities, by the way, see the word governmental activities, that will tell you that's accrual. And if you see general fund, that's modified accrual. Let's take a look at another transaction. And this is what really blows people out because you've expenditures, you go out and acquire an asset, but instead of debiting an asset, you are debiting an expenditure, which is called capital outlay. And you might say, why is this all happening? The easiest way to understand this is to put yourself into the picture. Think of your own checkbook. When you go out and buy a car or buy an expensive piece of furniture or whatever, you don't capitalize the asset. What do you do in your mind? That's money what? Gone, right? Works pretty much the same way because it's based on what? Flow of financial resources. Just like you and me, that's how we operate. I don't want to call it cash basis because it's not truly cash basis, but it's very close to it, okay? Under the governmental activities, this is what you would have done, okay? And internal service fund, we went through this. These are the activities which are internal business report activities. I won't go into this too much. Enterprise funds, let me just explain to you. So proprietary funds are divided into two activities, right? Internal service fund and enterprise funds. And enterprise funds are your business type activities. These are your electric, water utilities, parking garages, transportation systems, golf courses. And sometimes you might wonder, why do governments get involved in business activities? Why not just leave it to businesses to do business activities? Yes? That's right. Well, it's basically some businesses. Can you imagine riding New Jersey Transit if you had to have a rate of return for a business enterprise if it operated it? Because you know right now New Jersey Transit is subsidized by the state. Think about what that would do to the fares, right? So sometimes it's done as a subsidy, sometimes, as he said, it's done because it's just not feasible for a private enterprise to run that. But that's always a controversy. You always hear that. Always say, why is government involved in this? Why are they doing this type of stuff? Well, that's one of the reasons. And enterprise funds are your business activities. And as I said, proprietary fund common characteristics, similar to accrual basis, long-term liabilities are shown, depreciation is shown, which is not shown in the governmental funds because it's a non-cash expense. Expenses are recorded, not expenditures. And I showed you these statements already. Agency funds, let me just describe to you a couple of things here because these are, since we were talking, I talked to you about the pension fund and just described to you agency fund. This doesn't really happen a lot, but it's used in other parts of the country. Agency funds are basically funds that somebody's given you to hold temporarily, which you're then obligated to pay someone else. In some parts of the country, what happens is, in New Jersey, every town collects taxes, right? They all send you a tax bill. In other parts of the country, what they do is, instead of every town doing it, there's one county which does it for all the towns to reduce the cost, the administrative cost. They receive the money, right? It goes into an agency fund, and they disperse it back to the towns that are supposed to get their share. So that's what agency funds are. That's one purpose of it. But as I said, it's not a big thing. But notice, agency funds, assets equal liabilities. There's no net position because the government has no net position in an agency fund. Investment trust funds. And this is another area. And again, how do I describe this? Okay, so in New Jersey, if you were a town, New Jersey has lots of, as you said, 560 some odd municipalities. Every town has a little cash that they want to invest. So rather than go to their local banker and say, hey, we have this cash which we want to invest with you, what the state has done is created a cash management pool for all its municipalities and the state itself. So if you have extra cash, you wire transfer the money to the state pool, which is called the New Jersey Cash Management Fund. They get the money, they have your account, they know how much money you put in, how much money you take out, and you don't have to worry about whether the money is safe, trying to find somebody, the state does it for you. That's an investment trust fund. And notice the word external participants. State is state. External participants are other governments, which are municipalities. Those are, because that doesn't really belong to the state. What you give the money for investment to the state is really not state's, it's yours. And that's why it's shown in the fiduciary fund. And it's shown in the investment trust funds. A little complicated area, but not too difficult to comprehend. Private purpose trust funds, these are also not too large. I gave you an example. For private, as opposed to public, which were the permanent funds, private are for a specific group of people, where money's been given to you and you use it. By the way, do you see the word expendable and non-expendable? I know this is a lot of information. I can see it on your faces. You're like, okay, but we'll get better. Okay. Expendable is of trust fund where you can spend both the principal and interest. Non-expendable is a trust fund where you can only spend interest but not principal. So in one case you can give out both principal and interest, and in the other case you can only give interest, like the permanent fund. And then the biggest one of them, which are the pension trust funds, and we'll again spend some time on this, where people have deposited billions, the billions and billions of dollars which the state is managing on behalf of people who are going to be receiving pension now or in the future. And the money comes in, they invest it, and then they pay these folks over a period of time, but it's kept in the fiduciary fund because it's protected from bankruptcy. They cannot go after these assets, the creditors. Just like proprietary funds, fiduciary funds also use accrual basis, flow of economic resources. So what you are finding out now at this point is that proprietary funds and fiduciary funds operate very much like a business because they use accrual basis, statements look similar, except for the governmental funds. Okay? Now, one area is major funds, and let me explain this to you. And the best way to do this is by actually taking a look at an example. Okay, first what I want you to do is see these titles up here: general fund, special bonded debt, this, general project, and then non-major. When you see a title like these, are these major funds? If this is a non-major column, are these major then? Right? It seems obvious, right? That things which are listed in column are what? Major funds, right? So what happens is, if you're an accountant working for a government, question is, which fund do you show separately and which fund do you combine with all the rest? That fund that you show separately is a major fund. And that major fund needs to meet certain criteria. And that's what we're going to talk about. Any questions so far? Okay. Now this is, and actually I think I might have given you this as a homework assignment. I'm not sure, but I might have. Okay, there are 3 funds that are shown here. And this is how you would solve that. Road tax fund, debt service fund, and capital projects fund. There are 3 funds, right? Shown there. And you have the different elements: assets, liabilities, revenue, expenditures, and expenses. The question that's being asked here is, which one of those 3 should be displayed in its own column because it's a major fund? And you say, wow, what does that mean? Well, there's some strange stuff on the right. 10% of total governmental funds, 10% of the amount of the total governmental funds, and 5% of the total of governmental and enterprise funds. Remember we saw those 2 next to each other? All right. So basically the way to determine this is that if any one of these elements exceeds 10% of that number and 5% of the following number, it becomes a major fund. And you say, I'm now totally lost. Well, let's take a look at this. Assets, road tax fund. The assets are $1,369,238. Is it more than 10% of the total governmental funds? It doesn't meet that part, right? Let's look at the liability section. Is it 172,439? Is it more than 10%? Yes. But is it more than 5% of the total governmental and enterprise funds? No. Well, that doesn't meet the test. Revenues, that doesn't meet the test, as we can see, right? How about expenditures? No, that doesn't meet the test. So what we've just ruled out is that the road tax fund is not a major fund and can be combined as part of the non-major fund. I thought it'd be easier. Now what I want you to do is just take a moment and take a look at the debt service fund and tell me what you think. Should it be reported? Does it meet any criteria?